the one.
Hi, good morning, everyone, and welcome to Strategy and Stock Picks for the third quarter of 2025. Today's session is on the United States market. We still have some time before the session begins, so just sit back, relax, and we'll begin shortly.
Can we ask questions on the one? Can we ask questions on Zoom?
Yeah, so you send the paper in form.
Oh,
That's why I did.
so they cannot do Q&A lah. In the
Physical and online participants. We'll be sharing our QR code on screen later for our Q&A segment. If you have any questions, just scan the QR code and raise the questions, and we will answer as many as possible. We will also be flashing our ongoing promotions, as you can see on screen right now, while waiting for the speakers to get ready and for the session to commence. You may scan the QR code to find out more about the promotions where applicable.
in the chat.
You send me one.
Yeah,
This one I folded.
it's a US one.
Because you know it's black, so I'm not sure.
Yeah, I believe
So when I
everyone
open it, it's like in here, it's also say China.
This one you
this one's
send
the
me.
last
I'll start the feature promotion. Do you want?
See, it says China Hong Kong. SG.
This one you sent me. Oh no.
The wrong one.
Okay, yeah. Let me send.
Resend. Thank you.
I'll start the feature promotions. You guys are ready? Yep. Oh, the music.
Hello, good morning, everyone, and welcome to Strategy and Stock Picks for the third quarter of 2025. Thank you for taking the time to join us today. My name is Raj, and I'll be your host for today. Today's session is on the United States market. But before I begin, I'll share with you some of the featured promotions that we have ongoing right now. Firstly, we have our ETF promotion. So this is not a cash voucher that you can claim upon making a trade, but it's on a rebate fashion. Yeah, so all you need to do is, if you're already a bonus member, just swap your coins for the coupon in your reward segment, and subsequently redeem it to apply the coupon to your next eligible trade. You will enjoy a $10 rebate for every successful online cash buy trade on SGX listed ETF with a minimum of $1,000 gross contract value. You can expect to receive the rebate about 30 days after the promotion campaign ends, which is about early August or late July. Similar fashion, we have our Absolute 10 coupon for stocks as well. Similarly, you can just go onto the rewards page and redeem it using coins and make a respective purchase. Enjoy $20 or $50 rebate for successful online cash buy trade on Absolute 10 counters with a minimum of $5,000 or $10,000 gross contract value, respectively. Next. Trade SocGen DLCs at zero commission. This zero commission program is for customers who traded DLCs issued by SocGen from 1st July to 30th September, which is their promotional period. Just note that only buy trades will be eligible, and the cash rebate is capped at $200 per customer. You receive the cash rebate, you can expect to receive it at about end of November this year. Of course, please read the T&Cs before you trade. This is an attractive one as well. You will receive a $10 voucher for on-site subscriptions for any of the 7 listed ETFs if you are trading on-site today. So all you need to do is place a trade of any of the 7 listed ETFs here. You can head on down to our Nico AM booth that's outside and show them that you placed the trade. You'll be entitled to, upon showing, you'll receive a $10 voucher for doing this trade. Just note that it's only limited to the first 60 clients and with a maximum of 1 voucher per investor. Similar fashion as the first 2 promotions, we have a $20 voucher for SDR as well. So every $20 rebate for successful online cash buy trade on SDR with a minimum of $2,000 gross contract value. You stand a chance to earn up to $600 in rewards by referring your friends and family. So for every successful referral, which is a new client or someone who's new to Poems, using your referral link, you can get $60 in cash credit for each referral. You can either scan this QR code and key in your account number to receive your unique referral link, or you can find this link and just copy into your browser. Note that you will need to send them your unique referral link for you to be eligible to receive the $60 cash voucher. I'll give it a few seconds for you to scan this QR code. Perfect, thank you. Next slide. Enjoy 4.25% in new account margin financing up till 31st December 2025. Benefit from potential positive carry investment opportunities and expectation of rate cuts, etc. Lastly, do join our Telegram group page to receive market insights. You can just scan this QR code and join it. I'm in it as well, and I use it to receive key information on what's going on in the market. And it really helps me to stay relevant. I'm sure it'll be helpful for you too. Just give you a moment to scan this QR code to join the Telegram group chat. Okay, without further ado, let's start the session. For this session, we have Glenn Tam, Research Manager from Phillip Securities Research. With him, we have his team comprising Helena Wang, Serena Lim, Yip Ban Chong, Zane Orr, and Fahmi to present on the US big tech, US banking sector, and technical analysis. Let's put our hands together to welcome Glenn and his team.
Hi everyone. Thanks for taking the time, firstly on a Saturday morning, afternoon to come and listen to us. This is the first physical US session that we're having. We usually have it online on the webinar, if you're familiar with what we usually do. So yeah, thanks again. So we'll just start off quickly with our title slide. So we're looking at the third quarter outlook for the US. We'll be concentrating on the Max 7 stocks as well as the banking sector. Right, so we won't be we don't have much time, so we won't be touching on the macro. Otherwise, I'll be here until tomorrow. Yeah. So there's a lot of talk about AI and what it can help us with. But I think most of us we don't really get to feel it. So here at research, we try to put in some kind of AI where we can show that we're actually using the AI. And so this picture here is actually created all by AI. Right. So I just put in a prompt, and I said, you can take a guess, what it's trying to represent, but I think the aim that I was going for was that you can see the tech sector, and all the tech companies, and I think the dollar signs representing the bank, right? It's trying to go on a bull run, but then we have, our dear President Donald Trump here chasing them. I wanted him to pull the tail, but he couldn't go through. Yeah, so that's what we're trying to represent here in the outlook, at least for the next quarter. Yeah, so moving on to the next slide. Yeah, this is our usual disclaimer, just to note that all our information that we get is all from public sources, and please to look for your financial advisor before making any investments. Yeah, moving on to the next slide. Yeah, so our content will be just the 5 sort of major themes we're looking at. First one, we'll be looking at what happened in the second quarter, the performance. Sector themes will be a little bit heavier. So this time around, we are just going through each different sectors that we cover. And then we have the technical by Zane, and lastly ending the conclusion as well as the Q&A. Next. Yeah, so we'll just do a quick review of the second quarter market performance. Yeah, so gold was the outperformer. It's not surprising, right? It's just a lot of history. The Max 7 did pull back up in the second quarter, right? If you look at year to date, which is the blue bar here on the left, you can see that it's flat. Right? I think it's down slightly, like maybe negative 0.2% or somewhat. So we did see a lot of volatility in the second quarter, right? And that is sort of expected, with whatever happened with Trump and Liberation Day and the tariffs, trade wars. Yeah, so that's the main reason why they declined and then they just come back up. So essentially, year to date, we are seeing that the Max 7 is just flat. Right, so we still see that there's some room to grow for each individual, for certain of the sectors that we are looking at. I think we'll be focusing a lot on the AI and the cloud space. So that's where we see the most of the growth coming from. Moving on to the next slide. Yeah, so the USD, again, this is also not surprising news. I mean, if you follow the US markets quite closely, or even if you don't, if you're in Singapore, you also know that a lot of the USD was outflow, because they were trying to pull away from US dollar dominated assets. So it did plunge against almost all the major currencies. So on the left would be Europe, and then on the right would be more of the Asian sort of currencies. Yeah, so we're looking also at the concentration of the Max 7, and we are seeing that it has sort of stabilized. A bit of a brief history lesson for those who are not, I guess, as familiar with the Max 7 concentration. So it goes all the way back, we try to pull it past 10 years. In around 2016, 2015 actually to 2018, we saw this steady climb, and this was mainly driven by the growth in the first, the starting few big tech names like Apple, Amazon, and Microsoft. And then in the pandemic, there was a huge spike up because there was a huge demand for all these tech and digital services. So we saw this huge spike. But then again, from when interest rates rose, we saw a slight pullback. And also there's a bit of valuation compression and broader market rotation where they rotated out of the tech sector. And so recently, in the past 2 years, we saw AI making a huge resurgence. And then I think that's where we had Nvidia come out and be the largest AI player, right? And so there was this sharp rebound in 2023, mainly from the AI players like Nvidia, and Microsoft and Meta. And recently, what has happened is that we saw a mild pullback, right? It's really from the Trump worries and him and his tariffs, and trying to cut back on everything. But then again, after the market realized that, oh, actually he's they have this term, right, taco, right? So I think they start to realize that, okay, whatever he says cannot really be trusted. And he can swing either way. So they started to pull back again. So it's a bit of a correction. But year to date, like I mentioned earlier, it's quite flat, right? We haven't seen any movement. Yeah, so I think it's important to look at the valuations as well. So the current forward PE is around 27 times, and it's actually below the long-term average of 34. So one way to look at this, you can see that the Max 7 stocks are quite, I would say, cheap, right, as of current now. If you look at just the forward PE. So it will be it's an indicator that it might be a good time to come in, especially if you are confident of how well they will be doing in terms of earnings, which is what I'll touch on later as well. In the next slide. Yeah. So for second quarter, the performance, these are all AI-related stocks, right? We believe that has something to do with AI. They performed well, almost all of them. You look at Palantir, Palantir has both AI and defense, right? So you do a combination of the two, sort of the best performing sectors, and of course they performed well. But it might, in our opinion, it might be slightly overvalued at this point because the fundamentals don't link with how the share price is moving. And then we have Nvidia, of course, AMD. Netflix is not really an AI play per se, but we just put it there. And then the rest of the names, Microsoft, even Tesla was there, right? Tesla did very poorly. I will have more details on that, but they are also there. I think the only underperformer was Apple. And Apple, I think the main reasons why Apple did poorly is mainly because their AI was such a disappointment. Firstly, there wasn't any AI compared to Google, right, or even the China players. And also, right, they were hit by tariffs very, very hard. So that's the two main reasons, why Apple actually did quite poorly. Yeah, we have more detail. I think Elena will go through in more details on Apple later. So moving on to the next slide. Yeah, so this is what is a lot of numbers, right? But it's just showing the results of calendar year March, ending March 2025. So this is the Max 7's results. You can see what we are thinking is that the outperformers were actually gave the best guidance, right? Or even gave any guidance at all. So you look at Tesla, didn't really, they stopped giving guidance basically because they're doing quite badly. But I think the three companies that will do quite well and have done well would be Meta, Microsoft, and Nvidia. Yeah, so they all also are quite, in a sense, linked to an AI related stock, and they are also giving very strong guidance moving forward, at least for the next quarter. So we believe that these companies will continue to do well. Yeah. Moving on to the next slide. Yeah, so we'll just go into our sector themes. The first sector that we'll talk about will be the banking sector. Yeah, so it's not tech related per se, but I think there's some interest, and we do cover the bank, so we just touch on the bank's overview. Again, this is overview of the first quarter results. So non-interest income was really the factor that moved the bank's results, right? If you look at the net interest income, it's nothing, right? It's so stagnant. It's either down a bit, up a bit. But non-interest income, a lot of the banks, the US banks at least, they are relying a lot heavily on card fees, credit card fees. They are expanding greatly. But there's also comes a double-edged sword where they are able to get more card fees, but in the sense where they will get higher NPL or non-performing loans and provisions allowances from these card fees. So that's the biggest worry now in the US, where we could see higher bad debt because of the credit card fees where people are unable to pay. Right. But then for now, we are still seeing that it's quite healthy, the asset management growth as well. Provisions was roughly unchanged, and you look at the earnings, it was quite a healthy or double digit, really coming from the fee income. Next slide. Yeah, so for the banks, the US banks, the net interest income and net interest margins are holding still quite steady, right? They are managing to do this because they are able to cut their funding costs and they have managed to maintain the net interest income. So loans is still quite flat, flattish, 2 to 3% kind of loans growth. Rates have declined, but they are still able to hold it steady. So going forward, we believe that they are still able to hold it pretty steady, right, at around this range of around 3+%, right? And they are able to do this from the managing their funding costs. So a lot of them, they cannot control the top line by the loan yields because that goes by demand and supply. But by cutting funding costs, that's something that they can actually control. So that's how we believe that they will continue to manage net interest income moving forward. Yeah, there'll be more details on this. Yeah, so this is how we look at their net interest margins. It's basically asset and cost of funds repricing. So asset is how much they get from a loan, right? From an asset, the yield, and then the cost of funds is what they are giving out the customers, basically deposits. Recently, we are seeing that the decrease in cost of funds is slower than the decrease in loan yields. It's a bit confusing. So it's basically saying that they are now paying a little bit more to earn the amount of money, right? And we believe that rate cuts will be beneficial for the banks. You might think, oh, that's quite counterintuitive. Wouldn't rate cuts be bad for the banks because then they will earn less money? But for a US bank specifically, a lower rate cuts will actually allow them to further lower their cost of funds. And this will manage their cost of funds. And on top of that, I think there's another slide later where it will also improve loans growth. Because loans growth is rather stagnant because rates is still very high. A lot of people are holding this wait and see approach, hoping that rates will come down before they lock in their 20, 30-year fixed rate kind of housing loan. And also, one last point I'd like to add is that US banks do have a large majority in fixed rates. So that's where they can get the difference by cutting down their cost of funds. And then you can see that NIM improve a bit. So you would think that actually rate cuts would be quite beneficial for the US banks, especially now. Next slide. Yeah. So the non-interest, I won't be take that long on this, but the non-interest income growth, has continued to surge. In the last 2 quarters, we saw very healthy non-interest income. I mentioned it's coming a lot from card fees, asset management. Capital markets are quite vibrant now. So we are seeing a lot of this improving the non-interest income, and that is what is really pulling up their earnings. Next slide, please. Yeah. So loans growth is still slow, it's very sluggish, right? The blue line here is the GDP growth. It's still below GDP growth. We are seeing them, it looks like it's going to converge, so we'll hope so, but I think, the current situation now is that the consumer demand is slowing down a bit, from whatever Trump is doing, and also the interest rates are very high. So it's like a double whammy for the US consumer, where they really don't know where the situation is going to go, and it's getting expensive to take a loan. So, but we believe that it will be hovering around these levels unless something changes or if rate cuts come in. Then we could see it surge up even more. Yeah, next slide. Yeah, so another point for the banks that is a bit of a worry for a lot of people would be the allowances and the coverage ratios. Are the US banks, do they have enough to tide over a bad time, right? So the banks, the reserve coverage ratio has actually declined slightly, is the blue line here, right? But it's still kept above pre-pandemic levels. And a lot of the provisions that the allowances that the banks are putting on now is actually more than whatever charge-off that they have, right? So they are actually piling on a lot of provisions. It's very similar case here in Singapore as well, where you see all the banks, actually putting on more coverage, allowances or coverage ratios. it's really just to make sure that they have enough in case something bad happens, or like they call it the black swan event. So that's why we believe that it shows that the banks are quite stable in terms of their allowance coverage. Moving on to the next slide. Yeah, so the ROE has continued to rise for the banks, and we believe that they will continue to rise, especially while they will continue to lower costs. So the blue line is the ROE, and the orange line is the efficiency ratio. So efficiency ratio is something that they use to see how well they are, how efficient they are. Basically, that the name says itself. So you can see that it's sort of splitting up, and that's what we want to see, where ROE continues to climb, or they get more efficient with whatever they have, right? And efficient, it can be by like cutting costs, cost of funds, lowering expenses. So that's one way that they do it. So that's how to lower it, and to increase the ROE, it's just to make sure that they have better earnings moving forward. Yeah. So that's for the banks. Yes. So next, I also cover the auto sector, right? So the EV sector. Yeah. So it's a bit like it's completely different, right? Banks and then EVs. But anyway, yeah. So we will just be briefly looking at the EVs, and I think the main company we're looking at would be Tesla, because it is in the Max 7 and it's the largest EV player in the US. Right. So I think our main sort of title is, can they continue to take more market share from the traditional ICE vehicle? Right. So next slide. Yeah. So this is the US sales, US EV sales. There has been a slight decline, but this is actually year-on-year growth, right? For the EV sales, which is in the yellow line, and then Tesla's year-on-year growth in the green line. So you can see that it looks quite bad, right? Like we see that the line going downwards, but this is actually growth. It's just that the growth is decelerating. It's not a negative, right? So we are, for overall EV market in the US, it's still growing by around 11% year-on-year. But what is worrying is when you look at Tesla sales, it's the year-on-year growth actually declined, right? It fell by 9% year-on-year. Right? There are multiple factors why we believe this is so for Tesla in the US. One of them mainly, right, that he backed, I guess he backed the wrong person, right? He supported Donald Trump, and a lot of his, if you think about it, a lot of his customers are more, I would say more liberal, so they wouldn't want someone to back Donald Trump and to support. When they say you buy Tesla, it means you're buying into Elon Musk, right? But actually, Elon Musk is not the boss of Tesla, right? People have to understand that, but they don't. So a lot of fear. They have riots all over Tesla's factories. They even vandalize their cars. Yeah, so that's the main. I think one of the reasons why the sales decline. Another reason is also that they had their Model Y upgrade across all their factories, right? And they gave the reason that's why production slowed and delivery slowed, right? Nobody knows, right? I haven't gone into a Tesla factory to actually see it with my own eyes, but I think that's the main reason why deliveries have declined. At the end, I will also touch on the outlook of Tesla. Yeah, but it's a worrying sign when we see that the overall market is growing, but the largest player in the US has sales contracting, right? Not slowing growth, but contracting, and they're actually losing market share. And they can't blame the Chinese EV makers because they are not there in the US. So it's a lot of like the Japanese, Ford is even coming out, right, to come up to say that we are going to make an EV and people are buying into EVs, other EVs instead of Tesla. Yeah. Next, we're looking at the China market because there's also a very big market for Tesla, the China EV market. So EV sales in China has also continued to grow. Yeah, it's a bit confusing, sorry, this chart, but basically the blue bars you see at the back, that is the China EV sales year-on-year growth. So we are still seeing it, grow at like 40 to almost close to 50% kind of growth, the overall market. But for BYD, you can also see that their sales has sort of slowed down. Like they are the market share leader in China. And the main reason is that there are many, many, many small companies in China, like a lot of small EV players that just pop up and say, oh, I'm going to make an EV, you come and buy from me. Yeah, so that's the reason, that they are a bit like killing themselves, right? In a sense where there are so many EV makers now. And we believe that going forward, there could be a consolidation where only a top few players are left. Talking to some of the market leaders, experts in the EV industry in China, they have said that a lot of smaller players have actually just slowly just died off and just left the scene. And we have never ever heard any of the names. right? So that's one of the things that we believe moving maybe in the medium term, near to medium term, we could see a consolidation where the main like the bulk like, goes to BYD or even Xiaomi or NIO also. Yeah, so same story in China for Tesla again. Sound like repeating myself, but sales is down, right? I think this is a different story from the US, mainly because of the competition, from the China EV makers. That's the main one. I think that's why they're losing market share. Yeah. Okay. Next slide. Yeah. So yeah, this is just an overview of what I've been saying so far. Is that the market share in both China and their main market US has been declining. Not only that, if you look at their margins, it's getting compressed as well because their average selling prices have to decline in order to compete with all the other makers out there. So it doesn't look like it's a very bright picture, and we do have a sell call, with our target price of $200. I think I was at one point. I think I was the lowest target price for Tesla. If you look at Bloomberg, I think I was the lowest at one point, and he hit that once, and then after, he announced he's coming back, right? The whole Tesla share price just shot up. So a lot of Tesla, I'm just saying, a lot of whatever is on Tesla is not very fundamental. When we try to look at the fundamentals and all the figures, it doesn't match up with what the share price is doing. Yeah. So moving on to the next one, you'll see this is just some pointers for the outlook for the rest of the year. Right? The main things that we are looking out for in terms of Tesla. Firstly, I mentioned earlier, CEO Elon is returned to Tesla. Whether or not it's too early to tell if this is return can actually turn the tide for the company, or maybe this is too late. Secondly, the updated, the facelifted Model Y release will be, I think, sending out in June and July. So from then on, we can tell if the deliveries will improve, and if whatever they said that it goes to their factories is true or not. So we will be able to tell that in the third quarter figures. And last but not least, the test launch of their robo-taxi in Austin, Texas, will be also very critical to their future, especially in where they are trying to get towards full self-driving and AI-driven. However, if you have read the news and if you follow Tesla closely, the initial reports are quite concerning. There are a lot of incidents of the car like going off the course and just braking suddenly. Yeah, but of course there are also some positive reviews where they say that actually it's a very smooth drive. So I think they are still starting out. Of course, you get the other companies like Waymo. They already have a whole system set up. So it's a lot of playing catch up for Tesla. And that's why we do still have this sell call, because it's just a catch up story for them. Okay, I think that's all for Tesla. Yeah, I'll be handing it over to Iqbal, who covers the Semiconductor and Nvidia. Thanks.
Thanks, Ben. Yeah, hi. I'm Iqbal. You can call me Ben also. So I cover the Semiconductor sector, whether in the US or globally. So the main companies I cover is within the Semiconductor sector is Nvidia and AMD. Yeah. So this is just like a sector outlook of overall where the money actually flows. So if you think in terms of Nvidia chips, how do they get their revenue? It is mainly from hyperscalers. So for example, Google, Meta, Microsoft, and Amazon. Because when they invest in the AI infrastructure itself, for example, data centers, they'll need a lot of GPU racks in order to run their cloud functions, their AI models. Yeah. So when they announce that there's more and more capex coming up, as you can see, for the past 10 years, it's been in cycles, and recently it's been on an uptrend, and we do still see an uptrend because for 2025 itself, they are still guiding higher capex itself. So for the capex itself, we estimate about 50% goes to GPU racks itself. So this will directly benefit companies like Nvidia, and it also goes to memory chips as well. For example, Micron, and it also goes to networking technology within the data center itself. So this benefits companies like Broadcom. Yeah, next slide, please. Okay, so talking about PC sales. So this is another sector outlook which concerns Nvidia, because believe it or not, in 2019, before 2020, PC segment actually makes up the majority of Nvidia's revenue segment. Yeah, so this means that this includes the gaming chips that Nvidia sells, for example, your GeForce chips. Yeah, so overall, if you see the trailing 12 months PC sales, it has always been going up. This is because of inflation, and of course, you see our laptops, it's just getting more and more expensive, right? It's not coming down. So, however, if you look at the year-on-year percentage change, you do see that there's some cycles involved. And a large part of catalyst which causes this change in cycle is when the Windows version changed. For example, when Microsoft announced the end of support for Windows XP in 2014 itself, for example. Then how enterprises will behave is that you imagine you are holding a bunch of laptops that only support Windows XP. And then when Microsoft say, oh, we will end our support in 2014 itself, then it will slowly take time to change up the whole batch of laptops into new laptops itself. So there will be this a bit of lagging effect of about 9 months to 1 year. Yeah. So that is the time frame whereby after the end of support, we do see a growth in PC subsequently after that. Yeah. So for example, as you can see, when Windows 10 launched in 2015, there will be a slight lag before the PC sales boom again. Right. So coming back to today, the end of support for Windows 10 will be in October this year. So we do see that after the end of support for Windows 10 in October this year, there will be a slight lagging effect. So I personally think that there will be a lot of replacement for AI PCs, which will happen in next year itself. Yeah, so you can maybe in some of you all got very old laptops, and then you all try to run a ChatGPT model, it will lag slightly. Like why this ChatGPT so slow, right? Yeah, so this is what enterprises are being concerned also, because they have a lot of old laptops lying around. But if they want to revamp their entire company processors, they will have to switch it up and buy a new batch of laptops in order to run the AI models smoothly. And models like ChatGPT, they actually need a minimum memory RAM of 16 gigabytes. Yeah, so compared to the average memory RAM today, it is about 12 gigabytes. Yeah, so in order for companies to use AI processors efficiently, they do have to change their very old batch of laptops into new laptops. So I do see this kind of refreshment cycle coming in next year itself. It won't happen so fast in October. I do believe there will be a lag time, but I do see the rise in PC sales coming in 2026 itself. Next slide. Okay, let's talk about Nvidia. Yeah, so for Nvidia itself, as you all are aware, for their latest earnings itself, they actually took a hit in their China segment because US actually announced an export control itself on the H20 chips to China. So as you can see, this is for the next quarter itself, for 2Q26. And Nvidia say that they do see a very significant impact in their China data center segment. We estimate this to be about 90% of China's segment. Yeah, so as you can see, China's percentage revenue, which is the orange line, has been downtrending for Nvidia. And but the good thing for Nvidia is that they are less reliant on China, right? Because of the ramp in Blackwell to US companies in particular. Like for example, the hyperscalers mentioned earlier, when they invest capex, a lot of it goes to US infrastructure data centers itself. Yeah, so Nvidia's 2Q26 guidance, even though China takes a hit, it is still a plus 60%, plus 50% year-on-year increase for the next quarter itself. Yeah, so this is very positive for Nvidia because even though they took a hit in China, they are still giving very positive guidance. Yeah, so the main growth driver for Nvidia itself we see is firstly is Blackwell's ramp, because Blackwell gives the entire rack itself gives a 30 times better performance compared to its Hopper rack itself. This is because the Blackwell chips, they can stack 72 chips together, and each chip has 3 times the performance of Hopper itself. Yeah. Another so another sector theme we see for Nvidia is the removal of the AI diffusion rule. Okay, just a little bit of background. before Biden left, they actually came out with this AI diffusion rule, which separates all countries in the world into 3 tiers. So the first tier is the countries have unrestricted access to Nvidia chips. Second tier is companies can only have a limited amount of access to Nvidia chips. For example, 50,000 copper chips. Then the last tier is companies like China and those high-risk companies, which they say cannot supply chips to Nvidia cannot supply chips to these countries at all. Yeah, so this is Biden's last move before he leaves. But recently in May, as we have read, Trump actually took down this rule. He said he don't want this rule to be in place because it's very complicated. And we do believe that Trump took down this rule is because he wants to use Nvidia as a bargaining tool. He wants to use it as a way to negotiate with countries. Because, for example, if you think in terms of the previous rule, tier 1, tier 2, tier 3, Saudi Arabia and UAE are in the tier 2 countries. Yeah, so they are the ones who currently are pumping a lot of investments in Nvidia itself. So if you were to limit these Saudi Arabia and UAE countries from buying Nvidia chips, then Nvidia and American companies wouldn't even benefit at all. Yeah, so Trump, we do believe that Trump wants to take down this rule because firstly he wants to use it as a bargaining tool. Secondly, if Nvidia chips were to run on more companies globally, then there will be more models being run, more sample size, and Nvidia's technology can go even stronger. Yeah, so this is it does benefit Nvidia as well as US in general. Yeah, so this is why we think that the removal of AI diffusion rule will likely benefit Nvidia greatly because there is no such bureaucratic tiering of countries now. Yeah. So currently our rating for Nvidia is if y'all can see the target price, Nvidia's price has already run up quite a lot. This is because for the target price itself, we only base it on the reports that come out. So every quarter we will revise the target price again. Yeah. So yeah, this is why it's lower than the current target price. I mean lower than the current price. Yeah. So that's all from my end. I'll hand over the time to Fahmi. Yeah. Thanks.
So, good afternoon, everyone. My name is Fahmi, so I will be covering for the software. So, software and also cloud. So, the title is Cloud Growth is Going Steady. So, first slide is on about productivity software expanding steadily. So, before we go on the chart, right, let me give some sort of brief on what is there, right, actually. So, when we talk about software, I think the term that you guys would hear about often outside is called SaaS. So SaaS is basically software as a service, meaning it's referring to the companies that are delivering the product and services in the form of cloud through the internet, right? So, and we think that software are divided into 3 categories. So we think first is productivity, CRM, customer relationship management software, and ERP, enterprise resource software. So when it comes to productivity software, it means for the software that is used on daily basis on your work to produce productivity, right? For one of the example, company that is widely known is Microsoft, and some products I think that widely known are such as Words, Excel, PowerPoint. So this is a productivity software. So referring then, the next one is CRM, customer relationship management. It's for software that helps the companies, the clients to connect with their customer, right, to boost sales and boost relationship and all that. So that's what we call CRM. And one of the company example is called Salesforce. The third one is enterprise resource planning. And one of the example is Oracle. So one of the latest product from Oracle is that they have this enterprise resource planning that helps the departments within a company, such as the finance, HR, right, to integrate into one system, make it easier, right? So that's all the meaning of the productivity CRM ERP. And so we look at the chart, right, you can see that from the productivity, this was the main highlight actually. The productivity software, which is referring mainly to Microsoft and Adobe, is growing at 14%, which is double-digit rate, right? So in looking at the year before, it is still roughly around there, 13 to 14%. So we are seeing from this year over year that this productivity software is expanding steadily, right? While the other two, which is CRM, ERP, you can see that for the CRM, which is highlighted in the red line, is trending downward to one single digit from its peaks before, which we think because many of the enterprises nowadays would have CRM already, so they don't think they would need it. And then ERP is just growing slowly, steadily. Still a new market like the Oracle, just growing to the low double digit. So we are focusing on the productivity software, and we think that there are two reasons why companies this productivity software is expanding steadily. The first is because when we talk about the products, right? So like Words, PowerPoint, and Excel, it is widely used in the business. So we don't think that this kind of product would have, people are too familiar with it, right? So people wouldn't replace it so much, especially when we talk about Microsoft. Microsoft has existed since decades ago, and we use Windows, right? Then there's transfer to these products and all that. So when people are too familiar with it, so it's hardly that we see that people will change product, and people are using it too daily, and it's like hard sticky in the product. So we don't see that productivity software would come down in the news term soon. And we think that going forwards with the factors that we mentioned earlier, that it probably is going to expanding steadily at a double digit growth. So that's why we are focusing on productivity software. Right? Next slide, please. Then afterward, we have public cloud surge on enterprises demand. Right? Some definition on the public cloud here, it means for the companies that still again deliver their product in form of cloud through the internet. Right? Some of the examples that I think that we are familiar are Zoom. Right? You guys use it most often in the workplace, having that video call with your partner, client, and all that. Right? There's also some other company called Adobe. Right? For Adobe, they have creative cloud application where such of the examples are Photoshop, right? Editing video, Illustrator, and all that. So that's what we are referring to the public cloud here. So looking at the chart, right, public cloud has grown at the mid double digits, so I think that, and then we are expecting that moving forward, it's going to stay that way and growing at 17% CAGR. Right, there's many factors of it. First is I think is because first companies like to have cloud services instead of building their own and expensing a lot of money. For example, instead of them building their own data center in their own company, they could have like just renting out cloud services. So they don't have to spend a lot. They would just use the cloud services based on what they use, a fraction of the expenses. So it is very attractive for the company. So nowadays when you walk to the office, you don't have to see that one particular room that have a lot of computer within it, right? Nowadays they don't have that much of it. They just rent out the cloud services from like Microsoft, Google, right, the hyperscaler. Then we think that another reason of why we think that public cloud is going to see the next few years also is because there's so much integration from AI in the cloud service nowadays, right? Some two concepts that I think most people are familiar are called generative AI and also agentic AI, right? Looking at the generative AI means that the company have to develop, like when you put prompts like ChatGPT, right, it develop text, photo, and all that. So it helps the company to summarize, analyze, do their work faster, right? And there's also like save costs rather than having human to do this, right? And then we have the second one is agentic AI from one of the company called Oracle ERP product earlier. So they could analyze the products better within their company's information. Like for example, in the finance department, right? You could have agentic AI within it, and you give some information from the finance department, and then they could help you analyze this data and come up with decision making. So these things are one of the reasons that we think why moving forward, public cloud is going to grow at 70%, right? So that is quite attractive there in terms of the market. Next slide, please. So next slide is about hyperscalers profitability outpace revenue growth. So when we talk about hyperscalers, it's referring to the large companies such as Microsoft, Amazon, and also Azure, that where they own such a large data center and very advanced computing services. And they give this service called cloud computing and a lot of application within it that companies could access again without spending a lot of expenses from their company. So basically from the chart, right, what we want to say is that this operating margin, which is highlighted in the green, in the orange line, is growing faster than the cloud revenue itself. Like in the first quarter of 2025, the operating margin is growing at 25%, 24%. But the cloud revenue itself is only growing at 14%. So you could see that here that the operating margin is growing faster, and we think this is an early sign of efficiency here, right? And we think that there are many reasons for this. First is the integration of AI again. For example, for this company, for example, Microsoft, right? Other than they integrating AI into their product, they also integrating AI into their business itself. You read in the news nowadays that Microsoft is laying off 6,000 employees recently. So that's about 3 to 4% of their employees, right? So they are saying that instead of hiring these people that cost too much, if you just have AI to improve their workload faster and all that, they're also saying that recently that 30% of their coding is done by the AI instead of the coder nowadays, right? So we are seeing that the bottom line that these hyperscalers companies such as Google, Amazon, and Microsoft are having higher profitability while reducing their costs with the help of AI integration. Right. The next slide, please. Last slide is on Microsoft. When we talk about the macro, we talk about cloud, we talk about software. Now we go to the Microsoft, which we think is going to benefit from this industry that we have. So the title is called Cloud Powered Growth. I'm sure that you guys are familiar with one of the product called Azure, right? So for Azure itself, we think this Microsoft two growth driver would be Azure, and the second one would be the productivity business, which is the Microsoft 365. For Azure itself, it's for the cloud computing that were offered by them. The cloud computing is, again, it is where Microsoft offered a supercomputer where companies could access the supercomputer without them spending a lot of money. So this is very effective because they only spend a fraction of money, right? So we see that Azure growth is growing at 30% roughly up and down over the last few quarters. And this is actually quite difficult, even especially for large companies such as Microsoft, right? That the revenue from this Azure cloud is now 30 billion for this quarter alone, but they're still growing at 30%. And moving forward, Microsoft is expecting roughly that this Azure cloud services is going to grow at 30% because I think that the demand is still there, right? Their remaining profit obligation is around 300 billion plus, and that compared to their yearly revenue is about 60, 80 plus billion, and that is like 2 to 3 times more than what they could supply. So we think that is going to propel the Azure clouds is moving forward. And you can see the orange line is the artificial intelligence contribution. Right, since the last year, 2 years ago, I think the artificial intelligence contribution is growing higher and higher. And just in the last quarter, it grows up to 16%. Right, because to maintain this Azure cloud services growth of 30% revenue year over year is quite difficult. But we are seeing that artificial intelligence start to make contribution nowadays. Until now, it's contributed to 60%. But people keep saying nowadays that AI, they hardly see the visibility from capex that they spend, right? But Microsoft, we could see that their AI is trending upward. Right? For the second growth driver, we think is on the Microsoft 365, which is the product that you guys use again, the Excel, PowerPoint, and the Words. This product itself, the margin is growing slightly higher from 12% last year. Now it's growing 30%. The growth itself is not as high as Azure itself, which is the main revenue driver for the Microsoft. But then again, this make up the largest portion of the Microsoft revenue. And it's still growing, the margin is still growing slightly, and the growth is like 13% year over year. That's still great, we think. The demand is still there. I mean, like the enterprises customer that they have is also growing at 9% year over year. Right? For large company that is still growing, that is considered great, we think. So moving forward, we think that in the near short term, Microsoft would probably have some constraint in the supply, especially the cloud services, because they are recently saying that they have a lot of demand coming in, but they couldn't supply. So we're probably seeing that the growth for the Azure cloud is going to slow a little bit, but moving afterward is going to proceed going higher. And overall, we think that we are positive on Microsoft at a target price of 480, which is, I thought right now, if you look at the market, it's already 490 plus. Because we think that recently people are buying Microsoft more because they want to have exposure to companies that are less exposed to physical goods, like the other companies. Microsoft itself has only around 11% of the physical goods. So it would less likely be exposed to what we have nowadays with the Trump tariff and all that. It's quite a safe way what we want to have. So I think that's about it about Microsoft. That's all from me. Thank you for listening.
Good afternoon, everyone. My name is Reina. I cover digital ad, especially Meta and Google. So today I'm going to talk a little bit about digital ad, and the theme that we are going for is actually AI-driven efficiency. So let's start with the Meta. So moving forward, Meta will actually be full force on the AI investment. So this is why we think that it's very crucial for their monetization. So this is actually the last 12-month advertising revenue versus the operating margin. You can see that the majority of Meta revenue actually comes from the advertising business. So you can see that because of their AI investment, they can the advertising revenue is actually beat their guidance. It's actually grew around like 16% year on year at the moment. Yeah. And then this is because of the especially from the e-commerce vertical, and then because of the AI investment, you can see that their operating margin can consistently keep above like 40 to 50%, because the AI this is what they focus on. They want to do the AI investment in order to drive the efficiency in terms of to provide a better advertising performance. Next. Yeah. So when it comes to the indicator of how advertising digital ads are going to perform, one of the indicator is actually we look at the average advertising prices. So I'm going to talk about the blue color first. So you can see that one is actually the worldwide. You can see that from the first quarter last year to this quarter, to the first quarter 25, it's actually trend down a little bit to 10% year-on-year growth. Partly is because there's a reduction. There's a slowdown of growth of average price in Asia Pacific region. But then that's because that the impression growth, which essentially actually means that the available advertising slot available in the region is getting more, and then because of the demand can't really keep up with that. So this is why the average price actually slow down in the Asia Pacific region. But then if you look at the US and Canada, you can see that it's still gaining quite strongly. Currently, it's about like 14% year on year. Yeah. So this is why we still do think that there is actually a lot of advertisers demand it, because Meta can actually after they started to integrate AI to their products, they actually can provide a better advertising performance, which at the same time, in that case, that can actually boost the advertisers' return of investment. Yeah. So there are a lot of concerns about the digital ad spending for the online retailers after the announcement to remove to end the de minimis exemption. In April. So this is actually the official data from the China officials. You can see that in March, the shipping export from China to the US and also for Asia and EU actually spiked, which is very which is normal, because during that time before they started to implement the tariffs, a lot of consumers they started to buy a lot of stuff, and so this is quite picked up. But then the important part of this graph is actually starting from April to May. You can see that the export from China to the US actually dropped quite significantly. In April, it's around 21%, and then in May, it drops to about like 35%. So there might be some of the concerns that it might affect Meta digital ad spending. But then another silver lining we do see in this chart is actually the gain of the export from China to the other regions such as Asia and EU. For Meta, digital ad, in geographically basis, US account around like 43%, and then for Asian and EU is they actually account the rest of it, and then there is a very small portion for the rest of the world. So during the earnings calls, the management also thinks that also says that they do see that the digital ad spending actually being direct to other markets. So especially in ASEAN and EU. So we actually do believe that maybe the advertising revenue growth I mean, the concern from the US can actually be offset slightly because that is being redirected to other places. But on the longer term basis, we actually still think that the online retailers, they will keep starting to increase their digital ad to the US market. One of the reasons is because this is still one of the largest market for the consumer. And then another one is because if they want to redirect to other regions such as EU, they might actually have to face a little bit of regulation hassle. So this is why gradually after all the advertisers see that how the consumer sentiment, and they actually will gradually start to increase their digital ad spending in the US. Next one. For Meta, there is another business segment that we think that is quite interesting, which is that we do actually see strength in Thread. For those that doesn't know, not familiar with Thread, it's actually a new social media platform that is being launched by Meta in July 2023, and it's actually building on the Instagram infrastructure. And then this is a very text-focused-based social media. And then similar like Twitter, which is X, they focus a lot of like easier or like lightweight engagement with the community. Yeah. So since they started to launch, you can see that there are a lot of the monthly active user keep growing, and now currently it's like more than 300 million. We actually do think that this is one of the segment that can be that has a potential for monetization. Is because currently Meta actually have like more than 3 billion users, and then the more that they integrate AI into their products, and then it will start to increase their active user as well. And then Thread is also has a highest time spent growth across all the platforms. Currently it's around 35%. Yeah. So but then during the earnings calls, Mark Zuckerberg also says that this Thread is actually currently, they are not focused on monetizing it, but they might actually start to do it maybe next year. They are trying to build the momentum on it, which is now we currently see it. And then like I said before, we can see it based on what they already have in the product, which is the user, very big client user base. And the second one is the AI investment infrastructure. And then we also do see another strength in the business messaging, which is WhatsApp. WhatsApp business platform and the verified subscription actually contributed quite significant growth for Meta revenue. So I mean, for WhatsApp business, it's also is a Meta AI's actually has the highest Meta AI usage across all the platforms. So I think everyone saw the news that moving forward, Meta will have advertising business in the WhatsApp. So all the queries for the Meta AI, we do believe has a potential that to provide the efficiency for the advertiser so that they can boost their advertising business in the WhatsApp. Yeah. And then the next one I'm going to talk a little bit about is Alphabet. And for Alphabet is that we think that they are still dominating the search and ad business. So you can see that I mean Alphabet is one of the hyperscaler that they're gonna invest a lot of capex in their AI infrastructure. The latest number they're giving is that they're going to spend around like 75 billion to increase their to build out the AI infrastructure to build out their AI efficiency. And cost optimization is actually one of the efforts it has a lot in every quarter. So you can see that their operating margin keep like going up. Then it shows that their effort of focusing on efficiency is actually paying off. And then for Alphabet, another indicator to see what's their revenue potential is actually cost per click. So this cost per click is actually determining how much the advertiser actually has to pay Alphabet whenever there is a user actually clicks on the ads. And then both digital ad company, which is Meta and Alphabet, they actually actually set their pricing on the auction based system. So the price really depends on the demand and supply. And then for Alphabet, they focus a lot about on the keywords. And then we can see that currently the cost per click is still growing at a 6%. Yeah, it's still growing at 6%. So it's still pretty high. And then one of the verticals that one of the demand is actually coming from the insurance. So insurance is actually one of the most expensive vertical across all the keywords. So and for this one, we still do see that there is a demand for the advertising business. So I mean, of course that Alphabet is going to be affected because of the tariff policy. They do expect some of the headwinds, but we still think that they can be quite resilient. One of the reasons is because, like I mentioned it before, the AI integration to the product itself can actually generate a better ROI to the advertiser. So this is why we still do see that the advertisers are still willing to spend um, in order to reach their target audience. Yeah. I think that's all from me. I'm gonna pass the time to Helena.
Hi everyone, my name is Helena. So I'll be covering the last two sectors, which is e-commerce and hardware. We guess e-commerce is probably one of the sectors that got shaken the most after Trump came in and there's the tariff uncertainty. So this is just a table that we try to categorize a different sort of e-commerce company. So the first type is first-party retailers. So these are the ones that the company itself, they actually actively source for the products and they sell it on their own platform. And because it involves physical transfer of inventory, so actually the impact level for them is pretty high. So the example would be Amazon's own retail operations and company like Walmart. The second sector would be the third-party marketplace. So these are actually more like platform where they host third-party sellers. So yes, there's still goods transfers. So they do also suffer from that. But the thing is, it's mostly absorbed by the third-party sellers instead of the platform themselves. So in terms of the impact level, it's going to be a little bit lesser compared to first-party retailers. So we put it as moderate. And the third part is the direct-to-customer brands. So these are the brands that usually they have their own website and they have global delivery to the consumer's house. So they're also affected because there's physical goods getting transferred. So for them, it's high to moderate. The reason we put high to moderate instead of high is because the base is usually a lot smaller to big players like first-party retailers. The first category is probably the most severe category is our drop shipping and cross-border sellers. So these are the sellers who their sole purpose of the company is to purchase stuff from places where it's a lot cheaper and they take advantage of the price difference. So if the tariff is there and there's not much of the price difference, they don't really stand a chance to compete with local competitors because their strength is the price, right? I mean, for them, the delivery time is usually a lot longer than if you purchase from local retailers. So for them, people would just stop purchasing them. So when the tariff news came out, we see the Temu and Shein, they actually start spending a lot less in their advertisement for the US market because it just doesn't make sense for them to publicize anymore. They don't really have any competitive strengths. So for them, the impact is really severe. And the last one is also moderate. It's software as a service. So companies like Shopify. So for them, it's really, they're providing a software for the e-commerce. So for those who doesn't really understand what Shopify does, is they provide a service. So let's say I'm a company and I wanted to do online selling, but I don't have the necessary resources to do a website. So I can just subscribe Shopify. So they're going to do everything for me. I can just rely on their platform to sell my product. So for Shopify, they don't really deal with the direct transfer of goods. So we put as moderate. But just to highlight, even though we put it as moderate, it's still going to be pretty big effect because the fact that less people are going to be purchasing because the price went up. I mean, it's going to be detrimental to the entire industry. It's just compared to the first-hand retailers, the impact is slightly less. And the goods that are most affected, we think it would be consumer electronics, usually on the cheaper side, because that's when usually people want to import it from China. So, for example, it would be headphones and chargers, and then it would be clothing sectors, because these are the ones that usually people import from China. Okay, moving on to the next slide. So we tried to take a look at how it's been dampening the e-commerce sales. Actually, if we really take a look at the graph, we haven't really seen the effect kicking in yet. In fact, ironically, it even went up a little bit. So this is also understandable because consumers, they kind of expect that in the future the price is going to go up. So a lot of them try to preempt that and they try to stock up before the price actually went up. So if we really just take a look at the e-commerce sales, which is year-on-year growth, which is the yellow line here, we actually don't really see the effect coming. So it hasn't really kicked in yet. What's mentioning though is if we take a look at the blue bar chart, so that is actually the e-commerce sales as a percentage of the total retail. So we do see that it's actually slowly climbing up. So what that tells us is people are really slowly transiting from retailers to start purchasing for online. So that is definitely a good news for the e-commerce sector. Moving on to the next slide, please. Yeah, so for the e-commerce sector, we do cover Amazon. So the tariff coming in is definitely going to be detrimental to Amazon because around more than 70% of the goods sold on Amazon is actually sourced from China. So with the tariff coming in, the price is definitely going to go up. Nobody's going to be happy about it. So there's two ways Amazon can go through this. Either is they're going to try to absorb the cost. So they're going to that means it's going to crush their margin. Another way is they're just going to pass the cost to the consumers. And of course, that means people are going to spend less and the sales is going to go down. But the way we look at it is we're still pretty positive on Amazon in terms of the e-commerce sector because first is they have a really big base. They have a really big client base. They have a really big retailer base. So that gives them a lot of negotiating power. That also gives them a lot of variety of the sellers that they do have. So they can try to lean in more to the sellers that are least affected by tariff, like maybe Vietnam or Mexico. And they can also try, because there are so many different types of sellers on their platform. So some sellers, they would like to try to absorb the cost and try to gain market share, while others, maybe they want to pass the cost to the consumers. So they really have a more of a variety. Another thing that Amazon's trying to do is they're slowly trying to transit their focus to more on the lower cost essentials. So we think that is a pretty smart move because when the price went up, everybody becomes sensitive about everything being expensive. If you focus on the lower price and essential goods, it's more likely for people to do that. And they've actually been rolling out a lot of stuff, right? Like pharmacies, and they try to deliver like daily groceries to you. So these are the stuff that people have to buy, and they're relatively cheaper in price. So this kind of gives them a better cushion. So overall, we're pretty optimistic in their performance, even in the time where the macro environment is not very good for them. We still feel like they're going to be the e-commerce outperformer. Because if you really think about it, this is a situation that affects every single retailers. So at the end of the day, if the price went up for everybody, who are you still going to buy? You're probably still going to buy from Amazon because they're the biggest and they have a very reliable platform and they deliver to your house very, very fast. So at the end of the day, still, we're pretty positive on that. And another thing we would like to worth mentioning is Amazon, even though traditionally we think of it as an e-commerce company, it does like more than 80, around like 80% of their revenue does still come from e-commerce, but they're really slowly transiting to a more of a cloud company. So their AWS, like Fami just mentioned, has been growing really well. It grew 17% year on year. In the last quarter, it has been growing more than 15% year on year for the last 5 consecutive quarters. And AWS is a much higher margin business compared to retail. So the top line, the red line, is the AWS operating margin compared to the blue line, which is the retail operating margin. So yeah, the AWS operating margin is almost peaking to 40% and it's growing at a very optimistic rate. Like we mentioned earlier, because AWS, they're still seeing a lot of demand coming in. So for cloud company, if you want to get a hold of how how confident they feel about the business, you take a look at their capex spending, because the fact that they're seeing so much demand coming in, they are going to be willing to double down on their investment, because cloud industry, for their investment, it takes time for you to build data center. They really have to think in advance. So for them, if they see that they still have a lot of demand coming in, they would like to double down on their investment. It takes time for them to build. They want to make sure they have the extra capacity, so when that demand came in, they're not going to lose it to their competitors. So for them, it's really, if the industry is doing good, they were willing to be over invest instead of under invest. Because the moment you start under investing, you get caught up by your other competitors. It will be really hard for you to catch up in the future. So if you take a look at their capex spending right now, for FY25, their target is going to be around 100 billion US dollar. So that compared to their last year is 77 billion US dollar. So that is still a very big increase, especially when they have been investing very heavily on AWS already. So we think, yes, the e-commerce sector, the retail part, it's definitely going to compress their margin, especially they're trying to be the big hero here. So now a lot of the retailers, they're already trying to cancel their free shipping, or they're trying to increase the threshold. Like previously, you need to pay 15 US dollar in order to get free shipping. Now you need to pay $35. But Amazon is one of the very few retailers, they're still not changing their shipping policy at all. But with that being said, the price is still going to go up because there's a lot of third-party sellers that they're not going to absorb the cost. But Amazon is definitely taking the hit in their margin because of this. But because AWS is expanding so well and their margin is way higher than retail, we feel like that can potentially really cushion their margin decline and really help them ride it out in this difficult time. So overall, we still have a buy rating for Amazon. We have a target price of 260 US dollars. Moving on to the next slide. Now I'll be talking about hardware, especially smartphone. So for smartphone, we're seeing more, previously there's a lot of update about the system. Now it's really revolving about AI, like every single company is coming up with different AI features. So this is a graph of the global smartphone shipment. It's been pretty flat recently, but we do see that it's showing very slight rebound, around 5%. Okay, so obviously we're going to talk about Apple. So what do you think is the increase for Apple? The Apple's increase for the last quarter in their iPhone shipment was only 2%. So that's kind of really disappointing. It's like it's slower than the overall market. So that means you're basically losing market share. So moving on to the next slide. Yeah, so what really hurt Apple? So Apple recently, they had their worldwide developer conference. So if you're not really familiar with Apple, this is their annual conference where they usually would tell you like the updates, whether it's hardware, whether it's software. So this year, before the conference came out, there's a lot of people deducing what they're going to be talking about, whether it's going to be more focused on the software update or it's more going to be focused on AI. Like everybody's waiting for them to have some major AI announcement. But it was pretty disappointing. So it came out, most of the stuff is still software updating. Actually, like they spent 30 minutes at the beginning of the conference talking about their feature, which is called liquid glass, which is basically just a visual enhancement. So like the layout is going to be transparent and looks more niche. So really, it's pretty much of a disappointment. They do have some AI announcement. So they came up with this live translation, which is nothing new. So basically, when you text, it can translate to another language. Or when you FaceTime with another person, the person speaks a different language, you can automatically see the caption in your language on your phone. Another feature that they have would be the visual intelligence. So that is, if you see something on your phone, you don't need to go out. You can directly ask ChatGPT to search what it is about, or you can use Google to search photo to maybe you want to buy the same item, so they can help you find it where you can buy it. I guess the biggest feature that they have would be they announced that their ARM would be accessible to third-party players. So that is really like the biggest announcement they have. So previously, they actually said that they're going to announce their CV update. So that is something that everyone's been waiting for, but they didn't mention it at all during their WWDC. So they only came out later that they said it got postponed to 2026 spring. So actually, they got sued last Friday because people are upset. People feel like they're purposely telling people a shortened time because they're obviously not ready. Like they're kind of scamming the shareholders. So yeah, overall, it was pretty disappointing. So if we really look at Apple, Apple has been facing two problems for a pretty long amount of time. The first problem is, as a big company, as a company that big, their growth rate is very, very low, and sometimes even flat. And I think if you look at Magnificent Seven, they're probably one of the lowest growth company. So that shouldn't be the case if your company is that big. I mean, it's pretty alarming that the growth rate is so slow. So basically, their product growth is pretty much flat all the time. The only thing good about them is their service sector is growing like double digit for all the time. And service sector is a sector that has very, very high margin. So that kind of really help pull them up over the time. But still, if you really look at the product, it's flat. So when last year's WWDC is when they first announced their Apple Intelligence. So that is when people give this huge hype that, oh, maybe the product is definitely the next upgrade cycle is coming, that the growth is going to come in. Because it's a pretty logical time, because the latest time that we see a boom in the product growth is in 2021. So that gives you around 3-4 years. So that's usually the time that if you have your phone for 3-4 years, it's a reasonable amount of time that you start considering getting a new one. And if Apple Intelligence came out with all those killer features, it would be very natural for people wanting to purchase the newest model. But we've been waiting for 1 year now. That hype hasn't been realistic yet. And even this recent one, they're not giving us anything new. Actually, the AI feature that they do give us, other competitors like Google and Huawei, they already have it. So basically, they're really just playing an AI catch-up game. So for them, we don't really see a major upgrade cycle coming yet. So this very muted product growth is probably still going to drag out for the next few quarters. And another thing that's hurting them is the China market. So China market is a very big market for Apple. It accounts around 20% of their overall revenue. The China market has been struggling pretty good because they're facing a lot of competition from local competitors like Huawei, and who can produce phones with similar or even better qualities, which are with a much cheaper price. So they have been struggling. Their first half of the year, their China market actually decreased 7% year on year. And now with the tariff coming in, it's going to hurt them more because tariff means you're going to cost more to produce your phone. And that doesn't necessarily hurt their China competitor because China competitor, they're doing everything in China. They don't need any cross-border transfer. So for them, when you're already struggling at competing with the price and your cost of production is going to go even higher, it's just there's no way you can win the race. So when it comes to tariff, they did tell us about their estimated impact. So they impacted that for the next quarter, it's going to hurt them around 900 million US dollar. But they also warned that that's only for the next quarter. So for the future quarter, they refuse to provide any guidance. They just say it's going to be much, much higher. We think likely it's because the next quarter, because the news was so close, they probably did some preemptive moves to like maybe ship the resources like earlier than before to make sure they lock in the proper price. So that's really going to hurt them. And I think because in response to the tariff, Apple now they've announced that within the next 4 years, they're going to spend around 500 billion US dollar in US production. So they're trying to ship a lot of their production back to US. They're going to source certain glass or certain metal only from the US side. So in the future, they're going to be less fragile and sensitive to this kind of geopolitical tension. By doing that, your cost of production is definitely going to go up, right? So that is going to hurt them. So which is why we think combining these two together, we see a very limited upside for Apple. And because they're moving so much stuff to their US, we're definitely seeing the margin to compress. Even though we haven't seen it now, because right now it's still getting pulled up by services. So overall, we have a neutral rating for Apple with a target price of $200 US. Yes, I have one last slide. Yeah, so this is just to show the China smartphone market. So Apple is actually the green portion. So we see it used to be at 21%, then it slowly decreased. It started shooting up a little bit in the last quarter, but now it went back to declining again. So the other ones, especially Huawei and Xiaomi, they're really eating into their market share. So yeah, we're going to be continuing monitoring on that. So that's all from me. I'll pass my time to Zane for a technical analysis.
Okay, thanks, Helena. I'm Zain. I'll be sharing more about some of the charts and giving the technical outlook for the Nasdaq, S&P 500, as well as the Magnificent Seven group of stocks. So first up, looking at the Nasdaq, we saw a very amazing recovery in the second half. So Nasdaq was up, bounced back up 17% in Q2. And we also see, actually after what Trump posted on his Truth Social, when he said it was a great time to buy at the start of April after the Liberation Day, then it actually marked the market bottom. And after that, it went back up. It's currently at a record highs as well. So I guess Trump is always right. And for the Nasdaq, currently we see a recovery back above the 19,000 level, where this is the weekly chart, and the price has actually recovered back into the uptrend channel. And also importantly, above the 50-day SMA, which is previously acting as a support all the way back in 2023 as well as 2024. So I think in the third quarter, we are likely to still see the Nasdaq make higher highs going ahead towards the next target, about 21,000 as a base case. Yeah, next slide. Yeah, so next time I'll be talking about the S&P 500. So similarly, there was a very good recovery. S&P was up 10% in Q2. We see a recovery back above the key 5,700 level. So similarly, when you look at the chart in terms of the weekly price recover back above this uptrend channel, as well as the 50-day SMA. So S&P also formed a new record high this week as well. So I think this in this third quarter, we are likely to see this momentum continue ahead and possibly reach about 6,200 as a base case or even higher. Next slide. Yeah, then last but not least, I'll be talking about the Magnificent Seven. So Mag 7 did really just, especially the tech names for the Magnificent Seven, really carried most of the gains. The Magnificent Seven basket was up 20% in the second quarter. So the chart also looks quite similar. We still recover since the recovered back above the 24,500 level. Price has been back above this uptrend channel as well. Also, the 30-day SMA, this pink line, which is previously acting as a support. So I think we are likely to see more gains in this quarter to actually hit about 26,000 to 28,000 as the base case for the Magnificent Seven. So overall, still likely a very bullish outlook for the major indices for the US markets in this upcoming quarter. Next slide. Yeah, so this slide is about our US stocks coverage. So we actually do cover a lot more stocks other than those that my colleagues mentioned earlier. So you can feel free to take a picture. These are our stocks and our recommendations and target prices as well. Yeah, next slide, please. Yeah, so this is just to conclude, we have three main points for our presentation. The first one, we believe that the Magnificent Seven mostly beat expectations with growth being stable. Second point is that AI, as mentioned many times by my colleagues earlier, is still the main driver for revenue growth as well as margin growth. However, still need a clear indication of monetization. And last but not least, we do see a strong recovery. We do see a strong finish for the rest of this year after the strong recovery we have seen in the second quarter. So that's all for our presentation. Next slide. So this will go on to the Q&A segment next. Feel free to scan the QR code over here if you have any questions to ask us. You can also visit the link in the slide. So you can just scan the QR code and type in your questions, and we'll be more than welcome to answer your questions.
Hey, thanks everyone. So if anybody have any questions, feel free to raise your hand and we can pass the mic to you. If not, I think there's one. If there's no one, then I think there's one question here that someone submitted. It's about someone asked about Netflix as well. There's one. Yeah, so someone asked about Sophie, I think SoFi Tech. Yeah. So for those who are not familiar, it's basically this. I think it's a new banking kind of app. So they are very towards the younger generation, right? Where they have a good, nice looking app, easy to use kind of structure. They started off firstly doing a lot of student loans in the US, and then now they transitioned. They got a banking license in the US, and now they're doing a lot more loans, credit cards. So it's quite a young company, right? But I think they are trying to go towards the digital bank. But instead of what you would ordinarily think the digital bank is as serving the underbanked population, they are going towards the more affluent or those that would prefer to have an easy to use app but still have a full access of a bank, right? I think moving forward, their market is growing. They are still growing company. They're quite young. I think they have quite a bit of room to grow. I believe that there is still quite a lot of space for them to grow. But of course, the main competitors will be the traditional big banks, right? Like JP Morgan, Wells Fargo, Bank of America, even Citibank. So that will be what they're trying to compete with. And the worry is that if they grow too big, the big banks might just look at them and say, okay, I'll just emulate whatever you're doing because there's no patent on having a good app, right? So that could be the biggest worry. Similarly, here in Singapore as well, right? That's what the digital banks are facing. Yeah, so that's the answer to that question. Oh, okay, it's quite a lot that came in. Hold on. Okay, yeah, someone else about the target prices that they have already hit. Yeah, so what we do is that we do release an update to the reports and as well as to our target prices whenever the results come out. So during that time, we will definitely take a look at it. And when the new earnings do come out and we release a new report, that's when the new target prices will come out as well together with it. Okay. Yeah, sure.
Oh yeah, thank you for your presentation. I just have a quick question regarding Tesla. So based on your fundamental analysis, it's pretty much based on the Tesla's like sales and like growth margins. And I'm just wondering, what's your view on the Tesla's heavy capital expenditures on AI, and then
Yeah, good question. So they are really pushing a lot on AI. They're trying to be an AI company, but I think they're forgetting that the fundamentals is that they are a car company, right? They tell people, "Oh, I'm a tech company," but what are they selling? They're selling a car. So they are trying to move towards full self-driving, robo taxis. Even that funny robot that they try to do, the Optimus robot. So they're doing a lot of things, but I think they're losing focus. At least that's my opinion. They're losing focus on what they are supposed to be, which is a car company, right? So that's where they are losing focus. AI is good if you get it right, but what we are seeing is that they are like halfway there, right? They're not 100%. That's why they're full self-driving. I think the test launch that they did in Texas was like 10 to 20 cars and it's geo-fenced, right? If you can't even control that in such a small area, with only 20 cars and there are still errors, then something is clearly wrong, right? It's not fully there to be sent out to public. Like what we are seeing in China, we are seeing self-driving cars everywhere. Even in the States, actually, there is like way more and the rest. Yeah, so they are still far from it. He has I think the CEO does have very lofty dreams. He wants to be the next, I don't know, like the next, he's really the richest man, right? There's nowhere else for him to go. And so he does have very lofty dreams. I think that's the biggest thing, where I hope that when he comes back, he can pull the company back to where it was. Yeah. But as of now, they are spending a lot, they might start to lose money if you look at it, because a lot of their credits they get from the government. That's what's propping up their earnings. Otherwise, you will see, if you look at their financials, without their credits, they are loss making. If you break it down. So they are being helped by the government. Yeah. So they need to concentrate. That's the view. And now they are a bit lost. Yeah. Okay, let me see if there are more questions. Yeah, if anybody else has any questions, you can just raise your hand and we'll try to get to you. Okay.
Yeah, I'm going to take some questions. One is any upside to Netflix now at 1,300 US dollar, or is it a good time to short? Our target price for Netflix is actually 950. So back then when we issued the report, so we only issued the report when their earnings came out. So that time we have a recommendation of neutral. The reason the share price bounced up quite a bit is because streaming industry, it doesn't really get affected in terms of macro issues, especially with the tariff coming up. So if you look at it during recession period, usually streaming company is the company that do especially well. The reason being is it's relatively cheap compared to going out. So when the economy is bad and people no longer go out, they choose like the alternative, which is staying at home. So that applies to all streaming, whether it's movie, whether it's music, like Spotify as well. So yeah, and Netflix, if we look at the fundamentals, they have been doing really great. Their growth is really healthy and they're showing very exponential pricing power. So that means really the closest competitor they have is probably Disney. And Disney, the number of users they have is less than half of what Netflix has. So they're really like the monopoly in the streaming industry. And so just recently, they've actually increased their price. And even though they increased the price, people didn't stop subscribing at all. So that means they have really, really strong pricing power. Even they increase the price, people feel like, okay, it's still a decent amount of price I would like to pay. So really, if you look at it fundamentally, it's great. But the reason we have a neutral rating is because they've been doing well over the years. So all the positive news probably already priced into the share price. And the fact that their forward PE ratio is already way, way higher than their peers. So we feel like there's very limited upside. So now the price really shoot up after the tariff and everything. We feel like it's a good time to short. At least it's just market really over excited about it. So I hope that answers your question. I see other questions over there. I see Grab Holdings is recommended by. What are your thoughts on this? Actually, we just initiated Grab not so long ago. So if you're not familiar with Singapore, Grab is a leading super app in Southeast Asia. They offer services like ride hailing, food delivery. For some of you don't know, they also do like digital financial solution. So you can do like lending and borrowing from them. So they really have a very extensive ecosystem. If you really look at the primary driver of their growth, it's still their on-demand service. So on-demand service include both ride hailing and food delivery. They have been churning really positive growth over the years, and they've been doing it in a really smart way. They try to create brand loyalty, so they come up with a lot of VIP plans. Like I'm pretty sure a lot of you have it, like Grab Unlimited. So once you subscribe, and you're gonna be able to get like coupons. So in this way, they're trying to lock in to a lot of people that's more face forward. So imagine you can order food with so many different apps, but the fact that I already subscribed to Grab Unlimited, so now every time I order up to like above $15, I get a $3 coupon. So probably I'm always going to be sticking to order food from Grab instead of trying to order from Food Panda. So that is their way of trying to lock it in. And another sector that they're doing really well is their finance sector. their loan book alone surged 64% year on year just in FY24. The reason they're going to be able to grow so easy is they're using their Grab wallet. So sometimes, like, even you unknowingly, you're using their financial services, you don't even know. Because sometimes they will very smartly ask you to pay by Grab wallet instead of using your credit card. Then you're unknowingly using it. And the good thing for them is they have so much user data that they already collected from you. So they're going to be able to control how secure the debt is. So for people, they feel like you're likely not going to pay up, they're very easy to, they know how to screen you out because judging from all your spending pattern previously. So that is one of the reasons that they're going to be able to scale that fast. So yeah, overall we have a buy recommendation. Our target price is $5.8. I guess I'll pass the time to my colleagues to take out some of the questions.
Yeah, thanks for your questions. I can take on some questions here. One question is Max 7 all have gone up massively. Any new growth AI stock for us to buy and hold for growth? Yeah, so personally I cover Nvidia and AMD. So I think I will recommend AMD because AMD is like a little brother to Nvidia, and recently in their most recent tech conference show itself, they unveiled the new MI350 series GPU chips. So that GPU chip itself, the hardware is very competitive to Nvidia's Blackwell GPU. It has a 1.6 times memory performance as compared to Blackwell, and inference-wise, it is roughly in line with Blackwell. Yeah, so even though Nvidia has a stronger ecosystem build out as compared to AMD's Broken ecosystem, AMD's GPU hardware is still very competitive. So and it is market cap wise, it is about 10 times smaller than Nvidia. So I do think that as the entire AI scene grows, because of the emergence of DeepSeek, a lot of enterprises can run AI models at a lower cost. And this is also mentioned by TSMC in their results also. So I do believe that there's a lot of growth potential for AMD as well. There's one question specifically on Nvidia. Now Nvidia all-time high $158. Will it pull back to $130 or go higher? Yeah, I think short-term wise, I don't have a crystal ball, but so I really cannot tell short-term wise. But I do see a lot of volatility coming in short-term because in 2018 itself, Nvidia stock price is very heavily influenced by tariff announcements itself, and the tariff itself in 2018 actually put down Nvidia's profit margins itself because of the entire increased cost of production. Nvidia's profits actually took a hit. That's why their share price actually dropped 50+% in 2018 itself because of the tariffs. So fast forward to today, the tariff announcements does not apply to semiconductor chips, but who knows, maybe Trump one day he wake up and say they're going to impose some tariff on semiconductor chips. Then there will be a lot of volatility on Nvidia stock itself. Yeah, so that is for the short term. But however, for the medium to long term, as I mentioned earlier, because of DeepSeek's emergence, I do see a lot of increase in demand for AI. So in the long term itself, I'm still very positive on that.
Question. Last question on Intel. Is there a future for Intel? INT, yeah, Intel. Now you have Malaysian venture capital.
Yeah. So
listed also.
yeah. So
yeah, good buy opportunity.
Thanks for the question. Yeah. So the question for those who cannot hear is on Intel. So what are my views on Intel? Recently they have a new CEO. So the CEO, So he came in and he's the man being chosen to come in to transform the entire Intel. So right now, one of his execution strategy is to cut costs first and focus on his core business segments. Yeah, so I don't think that we still need some time to see how the execution plays out because on paper it sounds good, but I think it will still need at least 3 or 4 quarters before we can actually make a solid stance on whether in the long term it will go higher. Yeah, so right, I don't really have a view on it.
But no chance of it being multi-guided.
I mean, I mean, for it to become a multi-bagger, the execution has to be well. So how is I do see a chance whereby if they can focus their foundry to focus on the production of 2nm chips and subsequently 1nm chips, if they can be competitive with TSMC in terms of their foundry segment. And they also have to turn their CPU segment itself, because currently their CPU is still losing market share to AMD itself. Yeah, so that segment, you still have to keep a very close look out. For now, for now, my stance is not much hope, but we still have to look for the next few quarters now.
So I'm going to answer this one question. What is the difference between buy and accumulate for the recommendations? So basically, for accumulate is when the upside potential upside is between 0 to 5%, let's say. And for buy is when the potential upside is from 5% to 20%. 5 to 15% is for accumulate, and 20% and above is for buy. So I think another question here is that how to invest now when US market is all-time high, which area or sector or stock you see most value to invest now? So you see with a lot of volatility that we have nowadays with the tariff and all that, right? And whatever Trump said might even set back the market, and such as the other Max 7, even whatever people say it could go down, right? And they are quite susceptible to any setback that we could have in the market. We think that software, especially Microsoft, is a good stock to have, because while the others have so many volatility to them, like tariff and Apple and Amazon, e-commerce and all that, right? But Microsoft has, when it comes to software, they are in the form of subscription sales, meaning like they whatever happened out there, meaning that the revenue is already set there because people are paying by subscription, right? And again, add up is that what we are seeing growth in the Microsoft with the cloud revenue and all growing steady at 60% for the cloud revenue service. We think it's a good stock for you to hold by two reasons. That first is because the cloud revenue is doing well. Second, you would want to hold companies that have subscription service because they have recurring and stable income coming in and less volatile to any things that macro you have out there. Right? That's not for me.
Yeah, okay, maybe I'll just take one or two more questions. Next, someone here asks, is there an ETF for Mac 7? Yeah, it's under the counter MAGS. MAGS. Yeah, there's a few questions here on the Trump, asking us what is the forecast for Trump's tariffs and, next step in protecting US interests in the tariff war once the 90-day deal is over. And I think there's one more here. Yeah, basically just asking about Trump. Yeah. So I think no one can predict what Trump is going to do, right? It's like trying to predict. I was going to say, the word is a bit not PC, right? But yeah, he is, I don't even think his own cabinet can predict what he's going to do. So it's very hard to predict, but it seems to be what is playing out is that if the stock market doesn't perform well, right, then he will step in and say something that will make it bounce back up. Whether is it to benefit his rich friends, right, or because he looks at the stock market as an indicator of his performance. So you could see that if the market declines too fast, he will definitely step in to do something to prop it back up. So, when the 90-day deal is up, I think he has been really, taught this lesson. He really knows his lesson. Where if he says something quite ridiculous, like putting tariffs on even the Penguin Island, then the whole market will just crash. And then that reflects very badly on him because he looks at it as his performance. So I don't believe when it comes up, he's going to come back and try to try to put back all the tariffs that he had to pause on, right? Highly likely what happened is that it could be possible when he gives another extension, right? For those countries that didn't make a deal, he'll say, okay, I'm going to put it on you now. But those that they are in conversation with, he will probably either extend it or lower the tariffs. So that's the most probable scenario that we're looking at when the 90 days is up. And it's quite soon, right? I think it's in like a week or about a week and a half. So that's when we will know what is he going to do. But I think the market has really been pricing in that he's just going to backtrack and say, oh yeah, I'm all good, right? And now he also has that Iran-Israel war. Right? He's playing on so many fronts. It's really hard to see how can he actually be in control of so many things. Yeah, so I believe that it is very hard to predict, firstly, but I don't think he will do anything drastic because that shows his performance. That what he to prove that he's a good president. Yeah. So that's all. I think that we have time for. Maybe we'll just hand it over. Yeah, for the closing. Thanks. Thanks everyone.
Thanks again to our speakers for the presentation and interactive Q&A session. We have now come to the end of the session, and we'd like to thank all of you for joining. A reminder that a recording of this session and all earlier sessions are available on our PhillipCapital YouTube channel. You may view the recording of the webinar at your own time. Other interesting webinars going on almost every other day. You may view our full list of free webinars on our website. Also, just point you to the screen over here. Please take some time to scan this to complete this feedback session so that we can improve to make our subsequent seminars and webinars better for you. I'll just pause for a bit so that you can scan it. Not the questions one, the feedback one. While scanning, you may also join our investment communities to get free access to full research reports and discussions on technical analysis. Once again, thank you all for joining, and we hope to see you later. We would have our most popular session featuring the Singapore market later at 2:30 p.m. Gentle reminder to register for it and obtain the grand lucky draw ticket if you haven't done so yet. Also, there's a tea break at the foyer outside at Emerald Court. So just help yourself to it after this session. Also, for those taking the shuttle bus, the last bus to Paya Lebar is at 2:30 p.m. and the last bus to Katong Park MRT is at 2:45 p.m. May I invite all guests after this session to exit the room as we prepare for the next session. That's all from me. Stay tuned, take care, and see you in a bit.